Hey there, fellow traders. Welcome back to the channel. In today's video, I want to talk to you about options trading and specifically highlight the advantages of selling options compared to buying them. So I'm a Theta trader at heart. I love selling options. I love Theta Decay. I love making that money while I wait and while time is ticking away. So I've been trading for over 30 years. I've used nearly every strategy, dozens of services. I've won and lost a ton of money, nearly 40 years now. I've got books and binders and tons of old subscriptions to everything you can imagine. But I'll tell you, the most profitable I've ever been is when I sell options versus buying them. So I'm going to tell you why I'm really just a premium seller now and a Theta trader at heart, because I believe this is the way to trade. Okay, at least for me, this is the way. So let's jump into it and take a look. Start with some fundamentals on options. Options are financial derivatives that give traders the right, but not the obligation, to buy or sell an underlying asset at a predetermined price within a specific time period. What's all that mean? It really means that you have the right, if you buy an option, but not the obligation. You don't have to do it. You have the right to buy or sell a stock, a future, whatever it might be, at the price you selected within a certain amount of time or the expiration date. We're going to jump more into that in a minute. And we're doing this on either on puts or calls. So a call option gives the buyer of the option the right, but again, not the obligation, to buy the stock at the option contract strike price. A put option, if I'm buying them, gives the buyer of the option the right, but again, not the obligation, to sell the stock at the option's strike price. Why would you do that? Well, let's say you think a stock is going from 100 to 120. Okay. You could buy the 105 call option, okay, which gives you the right to buy it at 105, okay, but not the obligation to buy it at 105. So if it gets to 110, you can then exercise that option and buy the stock at 105, even though it's already at 110, and you've now got a $5 win automatically. So that's why you would use calls, and that's why you would have the right, but not the obligation. Now, if you buy that 110 call option, well, it's trading at 100, and it drops to 95 by the expiration date, then your option is going to expire worthless, and you no longer are probably going to exercise that, although you still have the right to buy it at 105, even though it's at 95. You wouldn't do that, but you have that right to do that. So let's talk a little bit about buying versus selling. So when you buy an option, you pay a premium for the right to be able to exercise that at a certain price, or the strike price. Okay? When you sell an option, you receive a premium from the buyer in exchange for you taking on the potential obligation to have to sell them that asset at the strike price. So it's the reverse. So when you're selling, you now don't have the right, but not the obligation. You now have somewhat of an obligation to have to sell the stock to them at that price, but only if it really gets to your price. So it doesn't happen all of the time. It will happen at sometimes. But when you sell, you receive a premium in exchange for the potential obligation that they're not going to exercise that on you. So you're taking an income to do this. So let's talk a little bit about time value. When we look at options, an options value is going to be made up of intrinsic value and time value, depending on where it is. That time value is also called extrinsic value. So intrinsic value is the difference between the strike price and the stock's price in the market. When the strike price on a call is lower than the stock's current price, it's in the money, which means it has intrinsic value of X amount. When the strike price is higher than the stock's price, it has no intrinsic value, and the entire premium is made up of just extrinsic value. So time value is the amount of premium in that option based upon how much time is left until expiration. The farther out you go, the more premium is in that option. So let's take a look at an example of this, and we're going to use Amazon here, and we're going to jump into the options chain. And I'm just, for the sake of today, we're just going to pick the 21 days out options. So let's take a look. If we were buying calls, right now it's selling for $130 and roughly 10 cents. So it's $130. If I buy an option at 128, that's 2 points lower than the current price, which means it's in the money, and I now have intrinsic value of $2, which is the difference between the $130 current price and the $128 strike price. So of this $4.65 that I would pay to buy it, $2 of that is intrinsic value, and the other $2.65 is time value. That's what goes into that particular premium. You can see as the stock moves up, you lose the intrinsic value and you only have time value left. There's no intrinsic value if I'm buying the 134 strike and we're at 130. It's not worth anything currently. It's not in the money at all. And this is strictly just $1.84 of time value. Same thing when we look at the put side in reverse. In the money would be buying something at a higher price. So if I'm buying the put here at 132, I'm $2 in the money on the puts. So my intrinsic is $2 and my extrinsic is going to be $2.15. Likewise, if I bought the 125 strike, there's no intrinsic value at all, and it's simply just time value of $1.25, thinking that potentially there is some chance that this option can get to that price in 21 days, so you're paying for some premium. That's how it works when you're developing time value or looking at the time value. Likewise, when I'm selling, okay, I'm actually taking in $1.24 at that price. So I'm still out of the money. There's no intrinsic value. It's strictly time value, but I'm getting paid for the time value as opposed to paying it when I'm selling. We'll talk a little bit more about that as we go, but that's quickly a little bit on time value. Theta. Theta is one of the options Greeks that measures the rate at which the value of an option changes with respect to time. Theta represents the daily decrease in the value of an option as time passes, with all things being equal, meaning that the price doesn't significantly move, volatility doesn't increase, a couple of those things which we won't really discuss much here today. But theta decay increases as the time to expiration gets closer. Okay, so the closer to expiration we get, the faster theta will decay. The farther out in time, the slower theta decays. But the overall goal for me is to let theta do all the heavy lifting. Selling options out in time for a premium, then I let theta or time decay whittle that price down for us. Several factors influence the rate of that theta decay, including time to expiration, as we just mentioned. Theta decay tends to accelerate as options approach the expiration date or as time moves. It does get faster and time erodes and the value erodes quicker. And then also volatility. Higher levels of volatility generally lead to increased theta decay because higher volatility increases the uncertainty and the potential for large premiums in that same time frame. So volatility can also impact time decay and theta. So let's talk about some of the advantages of selling options. Number one, when you sell an option, we immediately receive our premium from the buyer, and that's credited to our account. We get paid up front when we sell an option. That premium's ours to keep regardless of whether the option gets exercised or not. Either way, we get the money. Okay? It goes into our account and we have that cash. Okay? It can provide a nice steady source of income. You just keep selling options, you keep taking income in. So that's a fantastic advantage. I love to get paid to wait. Okay, so I'm getting paid to be patient out here. Most traders are impatient and they prefer to buy, hoping something's going to make a giant move soon based upon a bunch of different factors. I'm okay, just you pay me now, I'll sit here on the beach sipping a margarita while you work. Okay? I'm selling it to someone who is much more aggressive than I am. Another advantage of selling options are increased ways to win. Okay? When you buy an option, you need to be exactly right on the direction, the time, and the size of the move. You can only win in one direction. If you buy that option, okay, the stock has to move in the direction you were hoping it would go. So it would be up if it's a call or down if it's a put. Okay. So if I'm buying an option, if you remember Amazon selling for $1.30 right now, $130. If I'm buying the 130 option, I need it to go higher. If it doesn't go higher, I lose the entire trade. Okay. The premium will come out of that trade. The intrinsic value will disappear, or there is no intrinsic value, depending on whether you're in the money or out of the money. But I got to be right on direction. I got to be right that direction happens in the time frame. If I buy a 2-day option and it takes 3 days before Amazon moves higher, I lose. Okay. So I had to get the time right as well. And I also have to get the size of the move right, because if I bought an out of the money option on Amazon, let's say Amazon's at 130, I buy the 132. Let's say I got the direction right. It moved up from 130 to 131, and it did that in my time frame, but my option that I bought was 132. I will probably have made some money on the option until the last day when Theta completely comes out. And if it didn't move more than my premium, and my premium on that 132 option might be $2.50. Okay, so I paid $2.50. The option moves up $1. Okay, I'm still going to lose $1.50 if I close it, depending on the time frame. So when you sell, you don't need to be right on direction exactly. You just need the strike to not be hit. Okay, I'm predicting where I don't think the stock's going to go. So you can win if the direction is right, the stock doesn't move at all, or if it moves against you, but not all the way to your strike. So you can win 3 different ways. You can get the direction right. It could have no direction, or you could get the direction wrong, but not bad enough to hit your strike, and you win. I like the fact that I can win 3 different ways versus having to win one way and getting the direction right. The win rates are much higher. So instead of a 50-50 shot or a 30% chance of being right, okay, I usually have an 80 to 90% chance of winning. I like having more ways to win. All right, so time decay as well is another advantage here. We talked a little bit about it earlier, but the third advantage of selling options is taking advantage of time decay, which now works in our favor when we're selling. Options have a limited lifespan, as we've said. They will expire at a certain date and time. Their value tends to decline as they approach their expiration date, unless the price is moving significantly against the position. Okay, but normally, all things being equal, the options are going to decay as we move closer to expiration. So by selling options, we potentially benefit from the decreasing value of the option as time passes, allowing us to keep the entire premium if the options expire without being exercised, or in my case, I like to close early at maybe a 50% profit on many of the trades. Okay, we still get to close early, but we wait until enough of the premium has come out of it. But if we want to wait all the way to the end, perfect. We'll keep the entire premium if it expires without being exercised. So again, time decay works in our favor, not against us. Okay. Success rates. Selling options also offers a much higher probability of success for traders. It's because we can structure our trades to have a higher chance of winning. By selling out of the money options, which have a lower likelihood of being exercised, you increase your chances of keeping the premium and winning the trade. The farther out of the money you get, the higher the probability of not getting exercised. So again, taking a quick look at that and how that would look on our Amazon trade, let's go back to selling this 125 option on Amazon. This is 21 days out. I could sell the 125, which means I'm on the hook to have to buy it at 125 if Amazon goes all the way to 125 or lower. Then I might have to buy Amazon at 125. However, that's a significant discount from where it is right now. So it's $5 less. It's a great way to actually buy stock as well. I didn't list that as one of the advantages, but it's one way of getting in. We'll talk about the wheel strategy and cash secured puts at another time. But I can sell this stock, or I can sell the option down here at 125. So I'm taking in 100 and, in this case, let's make it a little bit more realistic here. So it's $120. I take in $120 as my max profit on this trade. I get paid $120 on this particular trade. This is an IRA account that I'm using here, so buying power is very high. But I'm taking in 120 bucks on this particular trade. Okay, if in 21 days the stock does not fall 5 points, I get to keep all 120 bucks and I walk away a winner. Looking at delta, delta can also approximate the chances of it hitting that strike in the time period here. So with a 0.24 delta, that's essentially a 24% chance that it will hit it, which means I have a 76% chance of it not going down this far. Okay, there's only a 24% chance that it can actually get hit. Doesn't mean it won't. Okay, but I have a high probability. So I have a 75% chance of winning this trade and keeping 120 bucks. Okay, so that's what we're looking at when we're looking at our higher success rates out there. So let's keep going here and take a look at the next piece, which is consistency. I love the fact that this is a consistent type of trade, because we know that if we put on the same trade time after time with the same expectancy of profit, like we just talked about, we can better plan our trades. Okay. Positive expectancy is achieved when we place the same trade setup over and over based upon the probability of profit and a fixed percentage and using a stop loss of X. I was going to diagram it out, but I'm not going to really get into it too deeply here. But essentially, if I know I have a 80% win rate, okay, so if I know I have an 80% chance of winning, which means like an 80 delta, like we just talked about with the Amazon trade, let's say we have an 80% chance of winning that trade, and let's say the average win is $100. Okay, I know that if I place 10 trades, I'm going to win 8 of them. If I do $100 each time, I'm going to win $800 out of those 10 trades. The other key is, what is your stop loss? Okay. If your stop loss is maybe 1x, so if my stop loss might be if the stock is losing or the option is losing and it doubles in price, and I have to close out and I lose $200, okay, or I lose $100, I'm sorry, 1x. If I lose $100 every time I lose, and I lose 2 out of 10 because I have a 20% chance of losing, now I'm losing $200 each time out of 10, but I'm winning 800 those 8 other times. So my net gain, my positive expectancy is that I will make $600 every 10 trades if I stay consistent. So I love the consistency of this. Buying options does not yield consistent results. You lose more trades when you're buying, but those wins can be larger. So the argument to buying options is lower risk, higher reward, but a much lower win rate. You might win 50% of your trades or less, but when you do win, it's a larger amount of money. But that's not enough consistency for me. I don't like the up and down nature of that. I prefer to win less money more often and use a consistent, repeatable, and mechanical strategy. And I like the consistency of putting on similar trades consistently and not betting that the market's going to, that some certain stock somewhere is going to go up. All right, flexibility is the next one, another advantage. You have the ability to customize your trades based upon your market outlook and risk tolerance. You don't need to do a ton of market prep on these types of trades when you're selling. You have a general theory that the market's either staying the same or going up. I mean, you always have a 50-50 shot, okay? But by selling out of the money, I'm giving myself a higher chance of being successful, so I can customize my trades that way. I can choose my strike price, my expiration date, and the types of options I want to sell on what types of underlying. So it allows me to adapt the strategies to a lot of different market conditions and adjust my position as needed. The flexibility and control that you get from selling is certainly a much more helpful feature to me than buying, especially for beginning traders. All right, last few things here. Hedging potential. Selling options can also be used as a hedging strategy. So hedging is a risk management technique that helps protect your existing investments. If you already own the underlying asset and you're concerned about potential downside risk, you can sell option contracts to generate income to offset those losses. Let's go back to our Amazon trade. Amazon selling for $130. Okay, so we've got $130. Let's say we buy the stock today at $130, but I think it might go down a couple dollars in the next couple months. What I can do is I can sell the call options that are out of the money, maybe at $135 or so, and take in maybe $1.50. So I make $150 on that. And if it does drop, yes, the value of my stock holding goes down, but I offset that because I was able to sell the calls and take in some additional income. So it offsets those losses, the paper losses. I get a realized gain that offsets paper losses on there. So it's like a form of insurance, provides a layer of protection against market downturns. So great hedging potential on those. So risks. One significant risk is the potential for an unlimited loss if the market moves against your position. There's always a risk that the underlying asset could go to zero. If it does, okay, then you have unlimited risk. Also, you could have a stock go up significantly and you have a significant upside risk you would be on the hook for buying that stock at a much lower price than where it is right now. So it's an important consideration and emphasizes the need for proper risk management and trade plan. Margin risks are also a consideration, as increased volatility can also increase your margin requirements. So you got to be careful how much margin you're using. I will never use more than 50% of my total buying power in my account, so I'm giving myself a cushion. So in conclusion, selling options can be a beneficial strategy for beginners and advanced traders. It offers income generation, takes advantages of time decay, increases probability of success, gives you much more flexibility and control, increases consistently, and can act as a hedging strategy. Just make sure that you understand the risks and fully understand how to put these trades on and off. I hope this was helpful, giving you an idea why I love selling options, because I love to be able to sell the option, take in the money right now, and then wait and watch as time just decays, and I continue to watch the value of that option dwindle away to zero, but I've already got the money, so I don't really care at that point. I like the consistency of that. I'd like to trade several of the same underlyings over and over and over consistently, where I know that on most times I have an 80 to 90% chance of success, and I'm getting paid 8 out of 10 times, 9 out of 10 times, and I'm able to limit my losses because I have a trade plan. So it gives me a lot more consistency in my account and allows for compounding. All right, well, I hope this was helpful to you. Hope you got some things out of it. If you like this video, go ahead and click like. If you're not a member already, go ahead and subscribe to this channel and click on that notification bell if you want to get notified on other videos that I'm putting out. Have a great day and enjoy your trading. Bye-bye.